Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. All right, Rob, the S&P is still finding support above its June 17th low, but this does not look like a rally either. It's just kind of meandering along, and I noticed it was actually near its May structure low, actually. So sure, it does look like the bear market's still in place, doesn't it?
Yeah, I don't think there's really any question about that, although I do think that labels do tend to get tossed around too much. At the end of the day, do you really care if it's in a bull market or a bear market, whether it's the stock market, the bond market? All you really care about is, can I take my $100 and turn it into more than $100 and, not go by way of $80 or $70, if you know what I mean. That's what typically happens to people. So, you look at today's market, and let's use the S&P as a proxy, but some people would call it a trading range. I don't think it's a trading range at all. And I think if you look at what I've said on Twitter and LinkedIn, really over the past year plus, I've been kind of documenting and timestamping my thoughts on all this. And I mean, so far, so good. This is a downtrend, which started to hint that it was on its way at the beginning of last November, 2021. And since January 4th of this year has been a pretty relentless trend down. I've referred to it in the past as nickels and dimes investing, where you lose 5%. I should say you make 5%, you lose 10, and you make 5, and you lose another 10. And you kind of can't win for losing, so to speak. And this is why I am such a big fan of kind of flipping the script and having people look at a bear market as something to be welcomed. Anybody can make money in a bull market. If you know how to make money in a bear market, you've got a special secret sauce that's not so secret because we're talking about it.
All right. So you're saying it doesn't matter whether it's a bull or a bear. You're saying it is possible to make money in the bear, but people panic about losing money in a bear. So to investors, it does matter. So say more about that.
Sure. So let's look at why they panic. As a matter of fact, let me turn this one on you, my good friend. Why do you think that people panic in a bear market?
Because they either don't have a strategy to deal with it or they are using outdated strategies like either buy and hold or stampede into cash, neither of which I feel is necessary in this day and age with what we have available now. That's my take.
Yep, I would agree with every single word of that. And I would add one more sentence, short sentence. The reason that people look at bear markets and say, oh my God, what am I going to do? Is because that's what they've been told is what they're supposed to do. And who says that there's a rule that the stock market has to keep going up and that's the only way to make money? I mean, literally, we talked about this last time we were together, okay? If you look at two ETFs, SPY, which I think everybody knows, tracks the S&P 500, and SH, which is the exact opposite, okay? And there's some funky math rules because if you hold it too long, et cetera, and the mathematics of loss, and I'm sure people can look that up. But look at SPY and SH. So, I mean, they're just two different securities. If you own SPY at certain times and you make money, and you own SH at certain times and you make money, what's so freaky about, why is that a problem? And so to me, I've just never understood why people don't invest in the market that they are given, not the market they wish they had. And this is a time where you're going to get a mixture of both. You're going to have sharp rallies because that's what bear markets do. And you know what? I mean, 6 months from now, I don't know if we're going to be in a bull market, a bear market. All I know is I will have a toolbox that allows me to express my investment preferences and beliefs as a researcher, because the ETF world, and I guess the options world on top of that, is, it makes it so that you can do that. And frankly, one of the biggest casualties of this is the investors that over-focus or exclusively focus on individual stocks. Because if all you do is look for stocks to buy, And you get to the point where 90+% of the stocks in the market ultimately end up lower for the year, which is often what happens in bull and bear markets. You just keep looking around for answers that you don't have.
Let me come back to the compare and contrast of the SH, which is the ProShares Short S&P ETF, and the SPY, which, as you said, most of our listeners will recognize what that is. I was at a party over the weekend, and I was talking to a woman I'm acquainted with who actually is making her living as a day trader and used to work on Wall Street. Isn't everyone? And she's been around. She actually used to work on Wall Street, so has some knowledge here. But I asked her, is she using inverse ETFs? And she almost physically recoiled, Rob, like, no, too risky, too risky. And it's very interesting because I feel like even people who are pretty seasoned investors who have some understanding of the markets, even they, I think, have been brainwashed, just to use that word, to feel like they only need to go long. Do you see that?
Before I answer that, just so everybody knows, because we're recording this so you can't really see us, but Kate just did one of the best impersonations of the robot from Lost in Space, for those of you who go back, that I've ever seen.
Danger, Will Robinson.
That's it. So Mr. Smith, right? Wasn't that the guy who was always worried about everything? Kind of like today's investor. So Here's the thing. The broad topic here is, how do you play defense, and knowing that your defense can also be an offensive weapon? Okay, so you can use SH if you have a stock portfolio, and I'm just using SH as an example. By no means am I recommending it or anything like that. What I will tell you is, I keep as long a list of defensive ETFs in my research lab as anybody I know. Because you want to have as many weapons as you can, first to defend a bear market and then to exploit it for your benefit and put that up against your offense. Remember, I'm always playing offense and defense at the same time. So how you play defense, if a lot of time, it's really just like putting together an all offense portfolio. Okay. If you look at the other side of your portfolio and say, okay, how do I want to play defense? Well, there are ETFs out there now which allow you to do something as simple as, hey, whatever the S&P does, I want to do the opposite. What's so scary about that? I didn't say put all your money in it, just like I wouldn't say put all your money in anything. There are ETFs out there where you can perform the opposite of the NASDAQ, the small cap, the EFA International Index, the emerging markets. There's even one that does the opposite of Bitcoin. And I'm not talking about leverage here, although there are some with leverage. I'm not a huge fan of that. But I will say, there are certain segments, energy, financials, et cetera, where you don't have a lot of liquidity going the other way. And so if you're not an options type that wants to buy put options on these things to try to either defend or make money in a down market for oil, financials, et cetera, there are 2x ETFs or single inverse ETFs. So again, I'm talking inverse entirely here, but there's so many ways to do it. And then beyond that, you also have these sort of baby step versions of these things, okay? We talked last time, I think, about TAIL, and I think we got some pretty good feedback about that, okay? TAIL is a symbol for an ETF that has 90% of its money in US Treasuries. What's scary about that? 10-year bond. But the other 10% is in VIX call options, which means when volatility, next time it goes from the 20s to the 70s, okay, you can make so much on that, it can reverse your losses in anything you have long and maybe even make your portfolio profitable. And there's so many other gradients of these things that mix offense and defense or allow you to isolate offense and defense. And frankly, Kate, over the last 20 years, going back to when you could only do this through mutual funds, this is my craft, not necessarily just the defensive, but being one of the few people I think anywhere that I can find, because I look for them all the time, but in the professional investment research space, to be able to have a full arsenal of defensive weapons, which first can be used to hedge against a market decline. And then when things get really crazy, exploit it to your benefit and try to make money in the down market.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes.
And I want to kind of take that thought and apply it to another area where you and I have both talked about the fact that investors may be a little bit in a mindset that doesn't really help them. For example, focusing on economic factors, the Federal Reserve, inflation, recession, the jobs report. And what I've seen people do, Rob, is make incorrect hunches and guesses based on what they're seeing on the news or reading. And what you're talking about here is using technicals to give you a picture of what's actually happening in the market. So what kind of price signals do you suggest that the listeners begin to focus on?
Like I think any good investor, I try to be my own worst critic and constantly figuring out what I'm doing wrong and how I can do it better. And it's funny because, in all the discussions that I've had with you and other podcast hosts and things, I talk a lot about the markets and about technique and all this, but I don't talk a lot about the fact that I pour through thousands of charts a week. My dad taught me when I was 16, so I'm 42 years into it. And I'm a firm believer that the market tells us a story through the charts. It's what I teach to all my interns and young mentors in the business. The problem is a lot of people just don't listen. So, think about it, whether it's the R word, the I word, the F word. I don't mean the F word, I mean the Fed. Okay.
I knew.
Yeah.
Yeah.
So, who cares how any of this turns out as an investor? I don't care about any of that. All I care about is that the stuff that I buy goes up, or if I buy it and it goes down, that I don't let it go down 20, 30, 40%, like a lot of retail investors kind of, let happen to them. And so, the charts to me, and I'm not talking, one of the biggest issues with technical analysis in 2022, and this was not an issue until now, but so many retail investors are technicians, okay? The problem is they're all working off the same playbook, kind of like your answer to my question to you before, and they're all just kind of copycatting everything else that everybody does. And when in the history of business, any business, they're just copying what the other guys do, well, was that like a great strategy? Okay. You're better off trying to be a step ahead of the game. And I think the way that you do that is, yes, you use technicals, use price action, but you can't look at the same moving averages and momentum indicators and all that stuff, because I'm telling you, Kate, and everybody else listening, in 2022, that SHXT doesn't work. Okay. It doesn't work the way it did. So, the markets are running away from that type of thing.
Okay, so what does then?
So what does is two things. One, multiple time frames. Okay. It pains me every time I see somebody looking at a stock or a ETF or whatever, and they're talking about the markets and they're using a single time frame. To me, on a regular basis, I'm looking at, and this is not because I always had to do this, but again, you deal with the market that you're given, not the market that you wish you had. So what that means in the charts is that I'm looking at hourly, 2 hour, 4 hour, daily charts, 3-day charts, weekly charts, okay, on a regular basis. Why? Because everybody who's kind of fixated on, I'm just going to look at the daily chart. I'm just going to look at the hourly chart. If you don't know what's going on around it, okay, these things happen in waves, moves up and down. They happen in waves. The short-term indicators in the charts start to move first, and then you see how much sustainability there is in that move. Okay, and that to me is the biggest thing. The second is, I think it's not enough to know how the indicators are supposed to work classically. You have to know how they are evolving with all the algo money, hedge fund money, index money, et cetera. Again, with the stock picking thing, okay, I'm not a stock picker per se. I do look at a lot of stocks all the time and I will own them, but the stock market itself, with individual stocks, a lot of times people say, well, why is my healthcare stock going down? They're doing so well. They just came out with good earnings. Well, if the sector's being sold off, you're the baby with the bathwater, right? So these are things about modern investing, I think, and modern ways to pull money out of your portfolio, or modern ways to grow your portfolio that really aren't given enough shelf space right now, because you can't scream above the big time media because it doesn't sell ad space.
You're talking about the fact that companies may have a good earnings report. They may beat expectations. I love that you brought that up, because I see this all the time. Is you go in there, you say, wow, hey, there was a beat. And then the stock is trading sharply lower. There was some little throwaway comment from the CFO in the conference call that panicked everybody. So really, you have to be so careful these days. That's something I've actually been noticing happening for the past year or so, that despite a so-called good report, the stock still gets pummeled, doesn't it?
And this goes all the way back to your earlier days in the business with IBD, where you're doing so much of this. Now, I will say this, okay? Let me postulate something else as we come toward the end of our time here. Isn't it possible that the reason that stock, that hypothetical stock, okay, is not being sold off the next day because of something that happened in the earnings report, but maybe it's being sold off because so many people wanted out of their index funds, and that stock happened to be one of the biggest ones in the index fund? You can't stop the tide. It's like trying to stop a hurricane, okay? You can't do it. You can't do it. So that to me is what I think is lost, how markets work, and especially how they work today, and how they work differently. They don't work completely differently, but there's a lot of things that are different from years and decades ago. And it's kind of like everybody is still just studying the textbooks, right? Ask any recent student, and I work with a lot of people that were students within maybe the last 5-10 years of their lives. And they come out of the classroom and they're like, oh, this is how the real world works. But there's so many people, especially when it comes to technical analysis, when it comes to understanding the markets, when it comes to what works in trading, I think that there's so much of that where they're still in the classroom, and, this is real life.
Right. Let me ask you one last thing here, Rob, before we wrap up. And you and I have talked quite a bit about how fast the markets are moving right now. You believe that buying the dip is a terrible idea right now. Say a little bit more about that, because that's another one of those things that's ingrained, isn't it?
Yeah, I'm glad you asked that question, Kate, because it kind of fills in what I was saying before about stock market, downtrend, et cetera. So I look at it this way, and I think I may have mentioned this the last time. I'll say I'm a bit of a show me. I'm not from Missouri, but I think I was there once. And this market, look, the thing I notice in technicals that works a lot more than like moving averages and things like that is just very simple trend lines. Okay. And so we've been in a downtrend in the S&P since January 4th. We've had a couple of fake out breakouts, as they call them, just above the trend, the prevailing trend line, and then it rolls back over and dies. And as this continues to happen, that is the thing that I think people have to look out for more than anything else, that basic trend lines have to be respected more than ever. Why? Not because I think so, but because there's a ton of money in algo and hedge fund and index fund land that apparently is making decisions based on these things. So just knowing that, and knowing who else is surrounding you in the room, in the big, big room that is Wall Street, is really something that has to be front of mind for traders, whether they've been doing it for 42 years like I have, or 42 minutes.
Always some thoughts that are contrary to what we're hearing in the broader marketplace, Rob. And I love that. That's why I like to bring you back on the show, because in this particular market, there's a lot there that the listeners can learn from.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.